It was an interesting day on Wall Street. We actually saw most of the indices lower today, not aggressively, but the S&P 500 did close lower by 0.78%. It was off the lows of its session. We also saw some sell-off there in the Dow Jones, down over 1%, and also the Russell 2000 down nearly 2%. But maybe one of the bigger stories today was actually the Nasdaq, which hit 10,000 for the very first time in its history, led higher by some higher quality names like Apple, which also hit its own all-time high here today. So it's one of those days where some of the junkier stocks that had been running pretty hard in recent weeks took a day off and went back to some of those tech stocks for once. So we'll take a look at all that, see what it means for our posture. We'll then get into a trade application that combines a couple different themes that have started to pick up steam here recently, including a foreign stock that is in the materials sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 9th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe while you're over there, sign up for our email distribution list so you can get notifications whenever we post these videos. In addition to that, we're heavy users of Twitter. I would encourage you to follow me. My handle is @BrandonVanZ, and thank you to everybody who continually clicks like and retweet on these Market Outlook related tweets to help encourage David and I to do these as often as possible. And then lastly, we have a presence over on Facebook as well. Feel free to join our group at the web address you see there in the logo in front of you. All right, let's jump into our charts. And as you can see, I've got chart 4B pulled up here in front of us. This is our 4 grid that will give us a good sense of what's been going on at a high level with the 4 major indices. And as I mentioned in the intro, the S&P 500, the most widely watched benchmark, was down 0.78% today. So a little bit of a give back, but you kind of have to squint in order to see that on the chart after such a furious rally we've been on. Just giving back only 0.78 is really not a whole lot. This is not what the bears had in mind for a sell-off type of a day. Certainly not a pull the rug out from underneath you type of a moment here. So the bulls are being somewhat resilient. You will see the Dow Jones fell about 1%, and then the Russell 2000 fell about 2%. And those 3 indices, the ones that were down today, actually closed with bullish intermediate confirmation signals. Remember, that signal exists when the green line is considered bullish. At this point, it is on all 3 of these charts because it's simply in the upper reversal zone. And then at the exact same time, the red line has to be in the lower reversal zone. And in this case, the red momentum line for the S&P 500 is down here at about 9. The Dow Jones Industrial Average red line is about 8. And then Russell 2000 is down here at around 10. Now, as you guys have heard us talk about in the past, there are better setups and worse setups when it comes to those bullish intermediate confirmation signals. Ideally, we'd love to also see the blue line between 50 and 20, and you can see in all 3 of those charts cases that is not happening. In fact, the blue line remains close to the upper reversal zone in all 3 of those charts, telling us that we haven't really had a true breathe out type of a moment, right? We're trying to look for these more obvious setups where it's a breathe in, breathe out, inhale, exhale type of a situation. Right now, we just had a little bit of an exhale, but not a normal one. And so some of you that have been waiting for a pullback probably are going to wait a little bit longer than what we received here today. Nonetheless, the signal exists, so I thought I would point that out for you. In addition to that, you'll see here in the lower left, the star of today was that Nasdaq Composite. As I mentioned in the intro, we did touch 10,000 for the first time ever today, and so that was pretty interesting. We got up and over 10,000. Didn't quite close there. We closed back below it, but the fact that we touched it for the first time in history is quite impressive. Remember, the Nasdaq Composite was the star during the dot-com bubble in 2000 and 2001 as well, but kind of sold off for several years and took many years to rebuild to its former glory, and now we are exceeding all those previous levels as well. And as I mentioned in the intro, is led higher by stocks like Apple that really had a nice outperforming type of a day. AAPL, of course, is the ticker symbol, largest publicly traded company here in the United States, second largest in the world after Saudi Aramco. And you can see here that Apple had a really aggressive candle here today. We were up 3% on Apple. That's a big day for that type of a company. If you look at the size of that candle right there and compare it to the size of most other candles on the board, that's one of the bigger ones that we have out there after kind of a long kind of grinding move higher, a nice explosion up. We've got blue sky ahead of us, with that particular stock. Nobody's ever bought Apple that is currently losing money if they're still holding their shares of Apple, and therefore there are no natural sellers out there for that particular security. So things are looking good there, and we'll see if that continues going forward. But right now it looks like it's pretty positive for that possibility. Let's go ahead and take a look at our next chart setup now, and this will be our 3 green arrows chart setup. 4D is the ticker symbol there. For those of you that are premium members following along at home, remember you have access to all 50 of the charts that David and I will use in these various presentations and the trading room classes that we teach for our premium members every day. As you can see here, we do have 3 green arrows on all 4 of our charts. We know that very easily from visual perspective to see that light green background color behind the candles of the current moves or the current candles on each of the charts there. So basically what that identifies on chart 4D here is that we do have 3 green arrows across the board. For those of you that are newer to that concept, 3 green arrows is just one way to express 3 different technical indicators and whether we would consider them to be bullish or bearish at one moment in time. And so right now is a strongly trending environment. Now, if you've been watching these videos religiously, that should not come as a surprise to you. You can see we've had 3 green arrows on most of these charts for quite some time, going back to May 20th on the S&P 500, and many of the other indices are very similar there. So we continue with our period of 3 green arrows on all of these charts, and it's still all systems go for the most part, despite the little bit of a sell-off today. Remember, a lot of people want to believe that the market rally has to come to an end at some moment in time, but the markets are going to do whatever they need to do, and right now we are seeing positive trends, and so we're going to try to press into those trends when we see those opportunities. All right, moving right along now, let's take a look at our 1040 crossover method chart. And this is chart 4C for those of you that are following along at home. We do have some new information to report. As of this moment in time, we have the S&P 500 with a bullish crossover. Several weeks ago, we identified the bullish crossover in the Nasdaq, which has been the leading index for quite some time. But it seemed like it was going to take quite some time before the rest of the indices would play catch-up. Well, guess what? We've just had one of the most epic bullish rallies in the history of the stock market. And that's enough to even push around some of the less sensitive moving averages out there, like your 10-week moving average versus your 40-week moving average. So as of this exact moment in time, you can see that orange line is above the blue line on the S&P 500 chart. You can see that light green background color forming behind the candle as well, identifying that at this exact moment in time, we do have a crossover of those 2 particular moving averages. Now, one caveat to that, remember, it's only Tuesday. If we have a sell-off for the next 3 days, remember, anything's possible in this market, it is possible that crossover would not be confirmed, which is what we would need since these are weekly candle charts we're looking at here. So we would need it to close in that bullish crossover by Friday's close in order to confirm that it actually occurred. Right now, it's in position, but since the weekly candle is not closed until Friday afternoon, we don't know for certain. But right now, it's looking highly, highly likely that we're going to end up with a bullish crossover on the S&P 500, which will then join the Nasdaq Composite, which has had it for the last several weeks. And next on deck would probably be the Dow Jones Industrial Average. You're seeing those 2 lines pinched together, and then shortly thereafter would be the small cap Russell 2000. So my oh my, what a 4-month run this has been. It's bending those moving averages as though it was kind of like Superman grabbing a bar of iron and just easily bending it and shaping it however it wants. And that's kind of been the bulls here during this rally versus the bears, kind of doing whatever they want with them at this point. So good news there for those of you that are looking for more bullishness from the long-term portion of your portfolio. All right, let's go ahead and talk about some 12 grid analysis now. And we'll start off with 5A. This is the asset class 12 grid. Remember, the background colors of these miniature charts that you see here during these 12 grids are going to identify whether we have a bullish or bearish intermediate term posture according to the market forecast technical indicator. So as you can see on this first chart, we have a mix of green and pink charts on the board. Let's start with the pink charts. And they are represented by long-term U.S. Treasuries, or TLT, the U.S. dollar, or UUP, and gold, GLD. I don't necessarily like to see that one. I was hoping that gold was going to have a little bit more of a move. Now, it did give me a little glimmer of hope today. Gold was up about 1% today, and some of those gold stocks were moving to the upside. But you can see that the path of least resistance on gold has changed. I was more optimistic about this commodity back here during the April and May time period. Now that we're in June, things aren't looking quite as rosy there, as we are now trading below a falling moving average. So we'll keep our eye on that story. Obviously, it needs to figure itself out in which direction it wants to go, but right now it's looking like it's leaning a little bit more towards the bears here. Remember, oftentimes gold is sought out as an asset class that is for safety or something different than stocks. When the stock market is out of favor, money will sometimes rotate into gold, particularly if the dollar is weak. But if stocks are in favor, then a lot of times people will liquidate their gold and go back into the stock market. And that's kind of where we're at right now. Now, that can flip on a dime. That's why we look at these charts every single day the way that we do during these presentations. But at this exact moment in time, it does look like gold is kind of whimpering at this point compared to when it was roaring back in April. The other pink chart on the board is this foreign bond ones right here, and you'll notice that that chart is a light pink color as opposed to this darker shading of pink on the other three. The lighter pink suggests that we do have a bearish intermediate posture, but it's not strongly bearish. It's just weakly bearish at this point. So maybe a chart that's in transition and trying to figure itself out right now. The intermediate line is at 57 right now on foreign bonds and falling. If it were to fall below 50, then it would join the others with that darker shade of pink on their background color. All the rest of the charts have the strongly bullish background color, or the dark shade of green. And we have a variety of charts and shapes and strengths that we're dealing with here. But you can see that the charts up on top, the S&P 500, EFA, which represents the developed foreign stocks, and EEM, which represents the emerging foreign stocks, all look very healthy at this point. You're noticing that if you're looking at their intermediate lines, you're looking at 95 for EEM, 96 for EFA, and 96 for the S&P 500 as well. Those are excellent readings. Remember that the market forecast technical indicator only goes to 100. So when you're up there at 95 and 96, you're kind of up at those upper echelon readings of strength and power in the market, and that's where we find ourselves right now. So it doesn't really matter if you're in the United States or if you're trading stocks in other markets. You're having some pretty good bullish trend trading opportunities that have emerged out of the bottoming of this stock market back in March. All right, let's go ahead and now take a look at some sector analysis. And before I go to the 12 grid on the sectors, I'm going to come over here briefly to the internet. First of all, thank you to all of you that clicked like on Twitter for me. The last time I did the video on June 4th, you can see that 109 of you did that. So we'll have a full-length video here tonight without any issues there. So thank you so much for those of you that continually do that day in and day out, encouraging David and I to continue to produce this free video for you. Also, while we're over here, I wanted to point out, I just got done making the factor selector calculations for my class tomorrow morning for those of you that are premium members, where we do some swing trading. And you'll see here that we did have a dip in momentum, a pretty strong dip. Remember, there's only 6 major factors that I'm tracking on this particular graphic. momentum is noteworthy because more than any other factor in the last couple of years, momentum has been the leader. And it's just been, relentless in some cases of outperformance. Even during the market meltdown in March, when you would think momentum stocks would be getting hammered, they actually held up better than the typical stock, which was a bit surprising. So things are starting to shift there a little bit. Some of you might have noticed that as well with some of your kind of work from home stocks that had worked so well in March and April. They're kind of falling by the wayside right now, and money is starting to rotate into things like banks, industrials, and materials and different things like that. So you will see here that this is showing us that momentum is now ranked fourth for the very first time going back at least 3 months. This graphic is a rolling 3-month graphic, and you can see that this kind of gold ball has always been ranked number 1 or 2 in the middle chunk of that, and then exactly 3 months ago we were at number 3. So this is the first time momentum has been at number 4, kind of in the lower half of those rankings there. So I thought that was worth pointing out because, of course, those were trends that I was already talking about with you guys last week during these presentations, kind of showing you those ratio charts of growth versus value and equal weight versus market cap weight and all those things that we try to educate you on in these videos on a daily basis. Also, while we're over here on Twitter, you can see that the sector selector was posted. Now I do this on the weekend, and I usually pin it to the top of my timeline over the weekend until I get into the middle of the week, and then I start pinning these market outlook related posts up there to make it easier for you guys to find. But right now you can see that the sector selector is up there, and one thing I wanted to identify is that we had quite a big surge here in materials. Now, technology is still hanging tough, so stocks like Apple and Microsoft are still working, but materials and industrials are really starting to surge here more recently in this most recent run on stocks that we've been witnessing in the last few weeks. And that's kind of come at a cost of some of those more defensive areas like your staples and your utilities. So I wanted to point that out because it will affect our trade application example a little bit later tonight. Just wanted to point out that materials is making quite the move on the graphic there, going from second worst 3 months ago to second best as of this moment in time. Now back over here to the Thinkorswim platform, let's go ahead and take a look at the 12 grid for the sectors. Now this will be the market cap weighted version. What I do on the sector selector, just so you guys are aware of it, that's an equal weighted version, so there will be kind of slight differences here and there depending upon what your preferred view would be. This is the more traditional market cap weighted version of it, where a stock like Amazon is going to have a much heavier influence on the discretionary sector than it would if it were looking at an equal weight version of discretionary. But anyway, as we look at this, it's pretty rosy out there. Now today wasn't the greatest of days. I would say that more sectors than not were down, and that appears to be the case because the only one that I'm seeing that was actually up, strangely enough, was technology. Technology was up 0.5%, and again, thank you Apple for your 3% move and being the most important stock in XLK because it is a market cap weighted index. All the rest of the sectors were actually down today, some of them fairly significantly. You can see energy really toppled over. It was down 3.6%, actually 3.7%. We had the utilities down over 2%. We had industrials down over 2%. So there was a fair chunk of give back in some specific sectors here today. Despite those pullbacks, the longer term trends are still fairly strong at this point. As you can see, all of these charts have that dark shade of green background color telling us that we have strongly bullish intermediate postures using the market forecast technical indicator. And speaking of materials that I mentioned before, you can see that the materials intermediate reading is at 95 right now. So it's not the highest, but it's certainly in that kind of upper echelon type of a range there. So quietly, the materials have been making quite the move in the market here recently. Even in the down and out sectors, I think there's kind of more general buzz out there about the financials and the banks and some of those oil stocks that are popping at very high rates, and then the industrials are getting a lot of press because of all the transportation related stocks like your airlines doing so well. So kind of left out of the conversation to a degree has been the material stocks, but they've been doing very, very well. You can see they're up about 22% in the last 3 months in this case. Now, of course, 3 months ago we were in the heart of the coronavirus scare, so we have to take that into consideration. But it's been a pretty aggressive move for those materials companies there. So keep them on your radar, since not a whole lot of people have been talking about them. And you can see lots of other strong charts out there. The vast majority of these charts are looking good. They're all trading above a rising moving average, I might add. You can see that healthcare is kind of slowing a little bit. It's still above a rising moving average, but you'll notice that the moving average is kind of starting to point a little bit more sideways. Whereas if you look at another graph like the discretionary directly above it, you'll see that nice kind of 45-degree angle in that 30-day moving average right there for discretionary. So keep your eye on healthcare. Remember, it was a leading area during the coronavirus scare, as you had some of those stocks like Gilead and Regeneron, Moderna, and Novavax, and all those types of companies that are trying to fight the coronavirus. They kind of helped keep the healthcare sector a little bit more elevated than maybe they deserved. So they were a leader coming out of it. But they've really spent the vast majority of the last month and a half just really tracking sideways, not making much progress. Whereas you do see a lot more progress being made in the vast majority of the other sectors that you see right there. So nothing necessarily wrong or support breaks or anything like that with healthcare, but just be aware that it's kind of slowing its momentum compared to where things were a couple of months ago with that particular sector. Let's go ahead and take a look now at some global chart analysis now. And I'm going to go over here first of all to 5E. This is the global stocks primary 12 grid. And as you can see, it's a clean sweep again. Now, remember, that's not a big surprise at this point because we were already having clean sweeps last week with the foreign stocks when I was doing those presentations. So it just is a continuation of that strength more than anything that we're witnessing right now. One thing that is worth pointing out as you look at all of these charts and you read those intermediate labels in each of those 12 charts, they're all above 90. Not just above 80. Remember, 80 is the upper reversal zone on the market forecast technical indicator. So anything above 80 would be considered strongly bullish. All of these are above 90. So again, can't stress how rare that is to see. Typically, when markets are functioning normally and we don't have some sort of epic crisis that we're dealing with, you're going to find a wide variety of performances across the globe depending on what's happening kind of more regionally and locally with those markets. But right now, it's just a pure risk-on mode across the board, regardless of the individual storylines of each of these countries. So things are looking pretty solid here with all of these. I want to point out real quick, Brazil is up there at 95 effectively on the intermediate line. It's had a very robust move here in the last 3 or 4 weeks. Remember, that was an area that was getting hit particularly hard with COVID, so it was kind of going sideways when the U.S. started rallying in April. Now you're seeing Brazil starting to play catch up in a pretty major way here after kind of putting in its more recent bottom on May 14th. So Latin America starting to catch a little bit of fire there. Now let's take a look at some of those secondary 12 grids. And for this will be chart 5G. And here, it's the same thing. We've got a clean sweep, strongly bullish intermediate postures across the board, no matter what area of the globe you're looking at. And as I look at all of these intermediate lines, all of these are also above 90. So it doesn't matter if you are a major economy, like a China, or a much smaller economy like Taiwan. We're seeing strength all over the place. And again, I wanted to point out Latin America, in this case, you can see Argentina is at 96 on the intermediate line, and has been more consistently rising than what we saw there with Brazil, but has been impressive nonetheless. You can see that Argentina is up about 25% in the last 3 months. And remember, the first part of that 3 months was a nosedive. So the fact that you're still up 24% from that level to where we're at right here is quite the run for Argentina. So again, we're starting to see some interesting strength develop there in Latin America. And then that kind of brings me to my topic at hand for tonight. So let's do our trade application example, and I'm going to come on over here to just a normal market forecast 1 grid. So this will be chart 4A for those of you following along at home. And I wanted to first bring up Peru. Now, we don't actually track Peru in those 212 grids that I showed you just a moment ago. It just doesn't have as big of an economy kind of work its way into our top 20 to 25 countries that are out there. Nonetheless, did want to point out that it shares some commonality with what we saw there with Brazil and Argentina. In other words, really good strength here. You can see that the intermediate line on Peru, so again, ticker symbol EPU, is about 96 at this point. So your typical stock in Peru is doing quite well. In fact, the other thing I would point out here is that you can see that EPU itself does have a green line in the upper reversal zone and the red line in the lower reversal zone. So similar to like the S&P 500 here today, where you have what's known as a bullish intermediate confirmation signal. So you could either trade EPU itself if you wanted a wider variety of stock holdings, a more diversified basket of holdings of stocks that trade in Peru, or you could pick 1 or 2 of your favorite Peruvian stocks themselves. And in this case, that's what I'm going to do, because I wanted to highlight the fact that we also have strength in the materials. Remember, if you were to trade EPU, you'd be trading Peruvian telecoms, Peruvian technology, Peruvian utilities, etc. So in this case, I wanted to focus on the materials, since they kind of have been a forgotten about sector. And the selection that I've made is BVN. Boy, Victor, Nancy. And this is Minas Buenaventura ADR, if I'm saying that right. Probably not. But this is a mining company. They mine a lot of copper and gold. And you can see that they also have a bullish chart at this time. Now, this particular stock does not have a bullish intermediate confirmation signal like EPU did. However, it does have a bullish green line here, and what mostly attracted me to it is the way that it is behaving around its moving average right now. You can see that this stock was at 10 3 months ago, fell all the way down to 5 in about a week, so it lost 50% of its value. So this is not for the faint of heart. But after bottoming there at about $5 per share on March 16th, the very next day it erupted way back up here to 8, and now has been kind of carving out this bottoming pattern along the way. Notice that it has reverted to the mean enough where you do have that downtrending moving average colored in red there, changing to yellow, and then eventually changing to green, where we find ourselves right now. So path of least resistance on this one continues to be to the upside. But I really like the way that it's kind of behaving around its 30-day moving average right now. You can see that after kind of breaking through its moving average to the upside right back here in kind of the end of April time period, it has managed to close above its moving average pretty much every single day along the way. You can see it bounced nicely off that 30-day moving average right there. It bounced nicely off its 30-day moving average right there. It bounced off of it again right there. Bounced off of it again right there. And that leads us to today. Today it came down to that moving average, touched it at its intraday low, and then bounced by the end of the day. Still closed lower, so it was down 4.9% today, but it did finish well off of the lows. The low price today was $8.13, and at that level, you're basically sitting right on that moving average. So it kind of looks like it continues to want to bounce off of that moving average as opposed to slice through it to the downside. So in this particular case, there's a variety of ways that you could play it. We try to mix things up during these presentations. I think what I'm going to do here tonight is a buy right. And a buy right is when you buy shares of stock and you immediately sell a call against it to generate a little bit of income. Now, when you're doing a buy right, you are effectively selling away or capping your upside potential. So if you think that this stock is going to go from $8 to $16 in the next month, you probably don't want to do a buy right. You're just going to want to buy the stock outright or buy calls, right? Or do something leveraged bullishly. But if you think it's going to continue to meander higher, which has been its modus of operandus here over the last couple of months, if that continues at this pace, then selling a call against your position will help finance part of your trade there. And of course, selling a call allows you to do that month after month after month if you so desire as well. So let's go over here to the trade tab of paper money. And let's see what we have available to us. You can see that if we go out here to the July contracts with 38 days until expiration, either the 10s or the 11s would probably be acceptable here. The 10s you could probably get filled at 25 cents or 30 cents right now. The 11s you could probably get filled at around 15 cents. In fact, the last traded price there was 13 cents. So I usually go for about the 1% of the strike price when I'm doing single leg sells like this. So in other words, if I'm going to sell the 11, I need to get at least 11 cents in credit, and that's approximately what's being offered at that point. So I think that's the one I'm going to go for. But remember, if you're less inclined to be that aggressive, by selling the 10s instead, you're capping your upside potential a little bit more than what I would be doing at the 11s, but you would be receiving more in income there than I am going to. So there's a little bit of a trade-off you'd have to think about in that particular case. So let's do the 11s in this case in the month of July. I'm going to right-click. I'm going to go over here to buy, and then I'm going to come over here to covered stock. That's going to load up down below. This is a really low price stock, so in this case, I think I'm going to try to do more than just 100 shares. Let's actually do 1,000 shares in this case. It's an $8 stock, and this is $1 million account, so we can afford an $8,000 position here without too much problem. So you can notice here that the debit shows 833 in this case, despite the current price of the stock at 850. What it's trying to do is subtract out the premium you're receiving from the sold call part of the trade from the current price. Now in this case, I'm willing to do something a little bit different than what it shows there, which is trying to approximate it by using the midpoint between the bid and the ask on the options contract. But remember, I'm comfortable with just 11 cents itself. So really, I could take $8.50, subtract out my 11 cents that I want to receive in selling that call, and I would actually be willing to pay $8.39 for this particular trade rather than $8.33. So I would be a little bit more aggressive by doing that, and that would help ensure a greater chance that I would get filled on the trade first thing in the morning as well. So I'll just leave that in there as a day order. If it doesn't get filled tomorrow, fine. We can find another trade after that. So let's go ahead and click confirm and send and ship that off, and we'll see if we can get filled first thing in the morning on that foreign mining stock in Latin America. Some stronger themes in the market here more recently. All right, well, thank you for joining me here yet again. Remember, we got an FOMC meeting tomorrow. Probably not a whole lot of hiccups there because market is expecting the Feds to stay pat, but keep your eyes on that commentary. David will be back with you tomorrow night to discuss all of that and more. Until then, best of luck with your trades and your investments. If you got value out of the video, be sure to click like for us over on Twitter. Thank you so much. Have a great night. Bye-bye.